Hey guys. Okay, let's talk about closing entries. All right, so we know that cash and bank through capital on the 6-column worksheet, those are what are called our permanent accounts. So those are assets, liabilities, and owner's equity. Withdrawals down, which includes our withdrawals, this random account income summary, which I'm going to explain here in a minute. Revenues and expenses are our temporary accounts. And temporary accounts mean that they are going to close at the end of the year. Well, that is what we're going to do today. Okay, so you want to think of the acronym READ when you're closing accounts. So like down here, I'm going to go ahead and put it up here. I was going to open Word. Okay, READ, R-E-I-D. Okay, R equals stands for revenue. Expenses is the E. I is income summary. And D is for withdrawals. I know, that's a weird one. Kids always have a hard time with that one. Okay, and so this is the order you have to close them in. READ, revenue, expenses, income summary, and withdrawals. So if you look at your revenue, it carries a credit balance, correct? Okay, that credit balance means we need to make it zero. How do you make a credit balance zero? You do the opposite. You debit it. So over here, you'll see that I debited equipment rental revenue for $10,629. Okay. And also at the top, notice I started with closing entries, and that's because usually with each transaction, you have what's called a source document, and these are closing entries, so don't really have a source document. So we're going to close equipment rental revenue, so we're going to debit $10,629. It is our only revenue account, so we need to have a place to shift this money, okay? We're going to shift this money, to our income summary account, which is right here, okay? So we're going to debit revenue and credit income summary. And then over here, the next one that we do, so that takes care of the R in READ, our revenue. Now we have E, the expenses. Okay, well, expenses carry a debit balance. The debit balance, in order to zero them out, needs to be a zero balance. Okay, so we're going to take all of the expenses and we're going to credit them for their amounts. Now notice before that I have income summary. Now income summary is going to be debited because our expenses are going to be credited. And so we always want to record debits first, so I put income summary first. Now 9 times out of 10 when I start this, I actually don't have that amount there. I just leave it blank until I list all my expenses and then I add it up. And if you add up all your expenses, it becomes $8,817, which if you notice is also the total in the income statement, my 6-column worksheet, which is just your expense accounts. It's a way to double check yourself. Okay, so now my revenue has a zero balance. Now my expenses have a zero balance. But in income summary, we had $10,629 credit and a debit of $8,817. Okay, so we still, if you subtract those two, have a debit balance of $1,812. And the I in READ is our income summary. So we're going to take that $10,629 and minus $8,817 to get $1,812. That is and again, it's a debit because our credit was bigger than our debit that we put into income summary. So we're going to subtract the two, and that's where we get this amount, and then we're going to debit it to income summary to make income summary zero. Okay? Then we need to have a place to go. Well, that's actually our net income amount. So if you look on the 6-column worksheet here, you can see that that's our net income amount. What does net income affect? Well, it affects our capital, right? It increases our net worth of our company, which is what capital is. So we're going to add our net income to capital. How do we increase capital? We credit it. So when we debit income summary, we're going to credit capital for $1,812. Okay? So that's the I in read. Now we have the D, the withdrawals amount. Okay, so D, withdrawals, we look on the 6-column worksheet, our withdrawals is 700 and it carries a debit balance. So guess what we're going to do to withdrawals? We're going to credit it. Okay, now what does withdrawals come out of? Withdrawals is anytime the owner, Mr. Ronald Hicks, decided to take money out of the business. Okay, so what he did here is, what we're going to do here is we're going to debit capital because we want that it has a negative effect because it's money coming out of the business. And capital increases on a credit. So we're going to debit capital and then we're going to credit withdrawals to decrease them. Okay? If you have any questions, let me know.